Monday open is where the trap either pays out or snaps shut. 48 hours ago, silver did something that should not have been possible in a functioning market. It printed a record around $122, completing a run so violent it looked like pure price discovery. 300% acceleration, retail FOMO, headlines screaming, "New era." Then the floor vanished. Here's the line you need to draw in your mind before tomorrow's open. The paper market sets the headline. The physical market sets the truth. And those two worlds can diverge, sometimes for days, sometimes for weeks, until one of them breaks. Lease rates are the cleanest, ugliest way to see this. A lease rate is what you pay to borrow physical silver. In a normal world, when metal is plentiful, borrowing costs are close to nothing. Think fractions of a percent, a quiet fee you barely notice. But when that rate spikes, when it multiplies far beyond its baseline, it is the market whispering, then shouting that someone with serious size is desperate for physical supply. You don't pay emergency room pricing for something that's abundant. You pay it when you're short, you're exposed, and time is running out. Now connect that to the other tell, vault withdrawals. When a meaningful chunk of silver vanishes from exchange vaults while the paper price is being smashed, you are watching a sophisticated decision. Convert claims into custody. Pull metal out of the casino while the casino is still offering chips. Because the foundational assumption of the silver derivatives world is simple and fragile, most contracts will never demand delivery. The whole system works because most players treat paper as good enough and never ask for the thing itself. But when bigger money, sovereigns, institutions, strategic buyers, starts thinking in terms of custody rather than price, the game changes. The poker table still looks full, the chips still slide across the felt, but now a few players are walking to the cashier and asking to redeem everything. And if the house doesn't have the cash, the house has a problem. That's what this weekend is really about. Not whether silver deserved to fall, whether the system can meet its promises if the demand for reality keeps rising. So why did the price crash if physical signals are screaming scarcity? Because the price you see is not a price of metal. It's a price of leverage. Silver is the perfect storm asset, smaller than gold, thinner liquidity, more violent moves, and a derivative structure that can be pushed like a lever when the market is crowded. When the dollar suddenly surged on political headlines, commodities priced in dollars felt instant pressure. Then came the mechanical chain reaction, margin calls. Over-leveraged longs who rode the move up got hit with requirements they couldn't meet. Forced selling isn't an opinion, and it isn't bearish. It's a liquidation algorithm with no soul. It sells because it must, and it sells into thin air. Once that avalanche begins, automated strategies smell blood. Stops cascade, volatility expands, and what began as a headline-driven push becomes a full liquidation event that has almost nothing to do with true supply and demand. You can have a shortage and still have a crash, if the crash is a leverage unwind. That's the modern market's deepest deception. It can print a lower price even when the underlying thing is harder to obtain. And it can do it precisely because most people never touch the underlying thing. Now look at what didn't change during those hours of carnage. Industrial demand didn't evaporate. Solar manufacturing didn't suddenly pause. Electrification didn't reverse. The strategic buyers who Donna T care about week-to-week volatility didn't. He suddenly decides they love paper promises again. In other words, the fundamental forces that built the rally remained intact while the paper structure convulsed. That's why the most dangerous mistake you can make right now is confusing volatility with resolution. This kind of liquidation isn't proof the bull is dead. It's proof the structure is fragile. It's the market showing you, in public, that paper can be slammed even while physical supply tightens in private. And that should make you far more alert than any headline about the rally being over. If you're here for the real mechanics, how paper pricing can diverge from physical reality, how liquidity traps are built, and how the next move often begins when the crowd is convinced it's finished, take 1 second and like the video and subscribe to Money and Empires. This channel exists for moments exactly like this, when the story everyone repeats is not the story that matters. And while you're at it, drop a quick comment. Do you think this was a real trend reversal, or a shakeout engineered to reset positioning before Monday? Because here's the banking trap in plain language. If you are a large institution that sold paper exposure near the highs, and the world is suddenly paying extreme rates to borrow physical silver, you have a problem. You need metal, but you don't want to pay up for it, and you don't want the public rushing in and draining inventory faster. So what do? You crush sentiment. You make the chart look like a tombstone. You create a violent enough downdraft that weak hands dump their physical back into the market. You trigger the psychological reflex that says, "Get me out, it's over." The trap works only if holders hand over the scarce asset during the moment of maximum fear. And the reason this matters before tomorrow, Tonight's open, is simple. If the physical market stays tight while paper tries to reprice lower, that tension doesn't disappear, it accumulates, and accumulated tension in a leveraged market is how squeezes are born. Now we widen the lens because this isn't happening in a vacuum. The crash coincided with something that should scare anyone who believes the dollar system is stable: visible turmoil around the Federal Reserve itself. The nomination of Kevin Warsh isn't just a personnel headline. It has a signal flare that politics is tightening its grip on monetary policy at the worst possible moment. Warsh's history matters because he's not a blank slate. During the aftermath of 2008, he was a loud voice warning about inflation that never arrived the way he predicted, pressing for tightening instincts while the economy was still bleeding. That track record is important because the present mandate implied by political pressure points in the opposite direction: easier policy, faster cuts, stimulus. When you place a figure with a hawkish reflex into a role being demanded to behave dovish, you don't get clarity, you get volatility. And volatility in monetary expectations doesn't just move stocks. It hits currencies, it hits rates, it hits commodities, it hits everything that trades as a derivative of confidence. Then the situation gets darker. Senators openly threatening to block a confirmation until unrelated investigations resolve, and a cloud hanging over the sitting chair. This isn't normal Washington noise. This is the perception, globally, that the institution anchoring dollar credibility is becoming a political battlefield. And here's why that matters. Foreign central banks and sovereign funds don't watch your cable news drama for entertainment. They watch it for risk. They ask one brutal question: is the reserve issuer stable? When the answer becomes uncertain, diversification accelerates, not as a protest, as a survival move. This is why the dollar's short-term spikes can be misleading. A headline can force a temporary rally, but structural forces don't reverse on a soundbite. If global institutions are gradually reducing reserve exposure, if trade settlement is quietly diversifying, if alternative payment rails are being built, the dollar can still bounce in the short run while weakening in the long run. And that long-run drift is what fuels hard asset demand. It's what makes silver more than a trade. Because silver isn't only a monetary metal, it's an industrial necessity. That combination is exactly why it becomes explosive in system transitions. Gold stores value, silver stores value and gets consumed. That consumption is the hidden fuse. If above-ground stockpiles shrink while industrial demand grows, the market becomes less forgiving. It can tolerate paper claims only as long as nobody insists on turning those claims into bars. So when you hear talk about paper-to-physical ratios, hundreds of claims per ounce, Donna T treat it like a meme. Treat it like the blueprint of a fragile bridge. The bridge holds if traffic is orderly. It collapses if too many trucks hit it at once. A few extra delivery requests, a few more institutions choosing custody over confidence, a few more weeks of elevated lease rates, and suddenly the math becomes non-linear. The system goes from manageable to impossible in a very small window. That's why these moments feel surreal. The chart says collapse. The plumbing says strain. And the outcome is decided by whether the market can locate physical supply without repricing dramatically higher. Now let's do the part most people avoid, because it forces a conclusion. Tariff-driven inflation is not a theory. It's a mechanism. When import costs rise, prices rise, and households feel it as a slow tax that never gets debated like one. And inflation, especially the kind that is policy embedded, does one thing with perfect consistency over history: it corrodes trust in paper. That doesn't mean paper assets die overnight. It means the premium on real things rises over time. Gold and silver have played this role for centuries, not because of superstition, but because they cannot be created by decree. So here now is the contradiction you've been reliving through. A world where inflationary pressures are baked in, industrial demand for silver keeps expanding, and yet the paper price can be smashed in hours. That contradiction isn't the market being irrational. It's the market revealing its dual reality. Price is leverage, value is scarcity. Look at the gold to silver relationship during shocks. When panic hits, silver often gets punished harder because it is more thinly traded, more leveraged, and more exposed to forced selling. That's exactly why, after the dust settles, silver can rebound with ferocity, because the same mechanism that crushes it, leverage, also becomes fuel when the direction reverses. If the physical market stays tight and paper selling exhausts itself, the bounce isn't a polite recovery. It's a scramble. And that scramble happens at the same time the world is layering in demand that didn't exist at this scale in prior cycles. Solar, electrification, grid expansion, strategic stockpiling. Silver isn't just a store of value anymore, it's a strategic input. This is where the $130 to $80 liquidation becomes something more than a weekend headline. It becomes a test of who understands the game. The institutions with the balance sheets and the access to wholesale supply can survive volatility. They can sit through chaos and accumulate into panic. The public can do the same, but only if they see through the emotional trap. The idea that a lower paper price means the story is over. Sometimes a lower paper price is the story beginning because it was the moment the system tries to buy back what it can easily source. The real question is not, did silver go down? The real question is, did the physical market loosen? If lease rates remain elevated, if vault outflows continue, if premium stays sticky while futures whip around, then the liquidation wasn't a cure. It was a symptom. So here's the question I want you to sit with, and I want you to answer it in the comments because it is the dividing line between reacting and understanding. If the system can still slam the paper price lower while the physical market tightens, what does that tell you about the true asset you own, the metal or the promise? And if confidence is the only thing holding up a paper to physical structure with massive leverage, how quickly do you think confidence can disappear once big money decides it wants custody, not claims? That is the heart of this moment. Not Monday's candle, not tomorrow's open. The question of whether you are holding something real in a world where real is becoming expensive again. Now we land this where it belongs, on inevitability, not prediction. People hear $150 silver and they treat it like a target thrown out to pump emotion. But the argument here isn't emotional, it's mechanical. You have structural inflation pressure embedded in policy. You have industrial demand rising through sectors that are not optional if governments continue their energy and electrification agendas. You have a global reserve landscape that is gradually diversifying away from single currency dependence. You have visible stress and politicization around the institution meant to stabilize expectations. And you have a silver market whose paper structure depends on the assumption that most people will never ask for delivery. Those are not 5 separate stories. They are one story told through 5 different lenses. And when multiple lenses point to the same conclusion, the market doesn't resolve it with a polite adjustment. It resolves it with repricing. The weekend liquidation is what happens when leverage meets a narrative catalyst. It's a forced unwind. It clears positions. It resets sentiment. It frightens the crowd. But it does not manufacture metal. It does not refill vaults. It does not lower borrowing stress in the physical market if that stress is real. And if the physical market is tight, every attempt to hammer paper lower carries risk. It accelerates the incentive for strategic buyers to take metal off market. The cheaper the paper price becomes relative to the physical reality, the more aggressive the conversion becomes. That's how you hit a liquidity wall. Not when everyone is bullish. When the system is trying to push price down and discovers it is incentivizing the very behavior that breaks it. So before tomorrow, don't let the screen hypnotize you. Watch the signals that can't be faked forever. Watch borrowing stress. Watch vault flows. Watch whether premiums detach from futures. Watch whether the sellers are emotional or forced. Because forced selling ends. Emotion exhausts itself. But structural demand does not apologize. And if this really is a trap, if the price was smashed to shake out supply, then the only way it works is if enough people hand over the scarce asset during the scare. If they don't, the trap flips. The institution that tried to suppress price becomes the institution that has to chase supply. And when that chase begins, the move is not gradual. It's violent. It's the moment the paper market is forced to acknowledge the physical market's terms. That's why this video is titled what it is. Monday Open isn't just another trading session. It's a moment where the narrative can harden and force more liquidation, or where the market can reveal, suddenly, that the selling was the last breath of leverage, not the end of the cycle. If you wanted one sentence to take into tomorrow, it's this. A crash can be manufactured on paper, but a shortage can only be resolved with price. And if the shortage is real, $150 isn't a fantasy number. It connects the kind of repricing that becomes necessary when a system built on promises collides with a world demanding delivery. So choose your side before the bell. Because when the music stops, the only thing that matters is what you actually own.